This presentation is presented by Tax Free Life Advisors, a licensed and appointed financial services organization with independent financial professionals and licensed agents nationwide. Over the next several minutes, we're going to look at the concept of long-term care planning, why it's important, and what are some of the best vehicles available today to do preparation and planning for long-term care. We begin with several questions. What is long-term care? Am I covered for long-term care? What is the cost and what are the chances? Do you have car insurance? Do you have home insurance? Do you have medical insurance? And if the answer is yes to all three of these, why do you carry insurance? And the answer, of course, is to protect yourself against the unknown or the possibility that you may have an accident, that your home may burn down, or you may need to go to the hospital and have an operation. Let's look at some statistics. For every 1,000 Americans over the age of 65, let's look at some statistics. For every 1,000 Americans over the age of 65, 5 will suffer a catastrophic loss of their home due to fire. 70 will have an automobile accident serious enough to warrant filing a claim with their insurance carrier, and a whopping 600 will need some form of long-term care. So what do you believe about long-term care? Do you believe that your kids will take care of you? Do you think that it will never happen to you? Do you believe that the government will pay for your long-term care? Maybe you believe that you're currently covered, or you may just feel like it's too expensive to think about and you're just going to hope for the best. Well, let's talk about how long-term care protection and policies work. Let's build a long-term care policy together. If we look at the national average cost for a qualified nursing home facility is $200 a day. And on a national average, the average stay inside of a nursing home facility is 1,100 days. So the average cost in this situation would equate to $220,000. Now, we look at building a long-term care policy based on your budget and what it is that you're hoping to accomplish. Now, generally speaking, we can build long-term care policies using traditional insurance, where we create a daily benefit and a length of coverage. We can build in inflation protection or no inflation protection, and based on your current age and health condition, we can generate a premium. Now, those premiums may be anywhere from $1,000 a year to $5,000 a year. It varies quite a bit based on your age and the amount of coverage and other options you want to choose. Of course, the advantage there is that you have long-term care coverage, you can budget for those premiums, and if you ever need them in the event that something transpires in your future, you'll have that coverage in place. Now, there are other ways, though, to prepare for long-term care, which we'll discuss in a few moments, because one of the biggest negatives in traditional long-term care planning is that you may be paying insurance premiums for protection or coverage that you may not use. Just like if you pay car insurance premiums every year, even if you don't have a car accident, you just keep paying those premiums on and on and on. Same thing for homeowners insurance. Your home may never burn down. You may never suffer flood damage or wind damage or any of these things for the life of your home, for as long as you live, yet you continue to pay those premiums year after year after year for something that you may not need. Now, statistically, there is a high percentage of our population that will need long-term care, and that's why we need to do planning and protection. But let's consider all of the options before us. Now, what about Medicaid? Is Medicaid an option for me? Let's make sure you understand how the Medicaid system currently works. Currently, if you have any assets or net worth, you are required to spend down your assets or your net worth to levels that are equate to or below $10,000. In other words, you cannot have more than $10,000 of total assets in your possession or in your name in order and still qualify for Medicaid. There's also a look-back period. If you intend to transfer your assets to your children right before you have to go into a nursing home, that way you maintain control. But in the very last minute, you transfer those assets away from yourself before you go into the nursing home. There's a look-back period with Medicaid that is 3 years, or actually 5 years if you put everything into a trust. So in other words, what Medicaid can do is they can go back and look at your history for 3 years or 5 years in the event of a trust and determine if you transferred any assets out of your name, and if so, they can pull those assets back into your estate and begin to apply them towards the spend down requirements. But only after you've exhausted all of your personal assets and net worth will there be an option for you to use Medicaid to pay for long-term care. Now, what about protecting your assets? There is a law in place, a program that is in place that is called a partnership policy or partnership certified policy, whereas you can have a long-term care protection and the total benefits of that long-term care protection will exempt your estate or your assets from the spend down rules. So the way it's currently structured, with the right company and the right protection, if you have a $200,000 total protection of long-term care and you need to use those benefits, you exhaust the $200,000 of long-term care benefits from your long-term care protection or policy. Then when Medicaid comes to do an assessment for whether you qualify for Medicaid to continue to pay for your care, they will exempt $200,000 of your assets because of the partnership of your long-term care policy. And I mentioned this previously, there are other options that you may consider as well. For example, if you hate the thought of paying for premiums for protection that you may not use, but you like to have the idea of having the protection just in case, let's consider some other options. Permanent life insurance is now available with long-term care benefits that can be used to cover you for long-term care, but also provide other various living benefits as well as death benefit protection in the event that you pass away. So let's take a look at how this might work inside of an Index Universal Life product. Now, Index Universal Life uses an index crediting strategy to calculate interest and to grow the cash value within the contract. Now, when we structure an Index Universal Life policy, we structure it in a way so that we minimize the amount of insurance cost or death benefit cost in order to maximize the amount of monies or premiums that are going into the index crediting strategy, so that the cash values will have the opportunity to grow over the life of the contract without being dragged down or minimizing their being dragged down due to costs of insurance and expenses and policy fees and so forth. So index crediting strategy is used and has a historical return of anywhere from 7 to 10% depending on the strategy that is chosen. Now, in our first concept I'm going to share with you, we're looking at an Index Universal Life contract with several goals. We want to provide a permanent tax-free death benefit. We also would like the ability to draw out a tax-free income during retirement, but we also want to have long-term care protection in the event that we need it. Now, the illustrated concepts here on the Index Universal Life is illustrating an average return of 8.11%. Now, the illustration provided contains non-guaranteed projections that may be higher or lower in the future. And we're also comparing the benefits of the Index Universal Life product with an alternative financial product. And we're looking at the alternative financial product as a comparison only. It's completely hypothetical and conceptual, but we're looking at tracking the returns based on the actual compounded growth rate of the S&P 500 from 1990 to 2010, reducing or deducting 1.5% for fees and expenses and not counting any dividends. We're then taking that hypothetical account value and rolling it into a guaranteed personal pension plan for income planning without any benefit or balance being left to your heirs or beneficiaries, which is currently estimated at a 5% payout. This illustration does not provide any legal, tax, or investment advice. It is an insurance product recommendation only. Please consult your insurance company product brochures and illustrations for specific information regarding the purchase of this product. So in our 45-year-old male, he wants to retire at age 65, and we're looking at an annual contribution of $20,000 a year from 45 to 65 years of age, or over a 21-year period. On his Index Universal Life, his day one death benefit is $444,000. At age 65, his death benefit has grown to $1,374,000, and he has the option or the ability to make withdrawals from his Index Universal Life contract. And the illustration shows $76,197 per year of tax-free income withdrawals. Now, if those withdrawals are taken all the way to age 90, this client would be able to draw out $1,828,000 income tax-free as a living benefit from their policy, and still leave their family, their loved ones, their heirs and beneficiaries with a tax-free death benefit at age 90 of $779,000. Now we compare that with an alternative financial product with the day one death benefit of only $20,000, the original investment, a potential account value at age 65 of $952,000, converting that into a guaranteed personal pension life income of $47,000 a year. At age 90, that's a total of $1,190,000 drawn out from age 65 to 90. And at age 90, leaving zero in the form of a death benefit for your family and loved ones. But what about long-term care? This Index Universal Life product has included or built into the product long-term care protection. It uses the base face amount of the contract of $444,000 and allows the policyholder or the insured to have a 2% monthly benefit for long-term care of the base face amount. So that equates to long-term care protection in the amount of $8,882 a month. So what about the total benefits of ownership with the Index Universal Life product with long-term care benefits? Well, at age 90, our total tax-free death benefit is $779,000. The total tax-free income that we've drawn out of the contract is $1,828,000. If we deduct the client premiums or contributions of $420,000, that gives us total benefits of ownership at age 90 of $2,187,000, in addition to the fact that we've been able to enjoy a bucket of money for long-term care benefits of $444,000 if we needed it at any time during our lifetime. So we compare the total benefits of ownership now between the Index Universal Life and the alternative financial product. You see the numbers there, $2,187,000 versus the alternative financial product of $770,000 with actually no long-term care benefits at all. Let's consider a second option, and this would be tax-free wealth transfer strategy with long-term care and living benefits. And in this one, we're looking at a 60-year-old male who's a non-smoker, and he's going to convert a single premium of $250,000. He's going to receive a 10% premium bonus on his initial contribution. He's also going to receive a monthly maximum long-term care benefit of $7,576 a month in the event that he needs long-term care. He has a minimum tax-free death benefit of $468,000 if he were to pass away that will go to his family. However, over time, using an index crediting strategy, his projected death benefit will grow to $692,000 if he were to pass away at age 85. And in the entire time that he has this particular contract, he has from day one a money-back guarantee or return of premium rider. So no matter what, without any penalty or charge or surrender fee, he can draw out his $250,000 if he needs to or wants to for any reason at any time. So this is an alternative to making a traditional long-term care premium payment that, depending on your age and the amount of protection, could be anywhere from $1,000 to $5,000 a year for the rest of your life. Instead, you can set aside a single premium one-time payment, create a bucket of money that will grow and earn interest, provide long-term care protection, and a tax-free death benefit for your family. Or, of course, you have the Index Universal Life product that can generate a tax-free income during your life, along with tax-free death benefit and long-term care benefits as well. So who will get your legacy? Will it be your family, your church, or your charity? Or will your legacy be eaten up through the medical profession and fees and expenses and costs for care? Or will it be taken by the government in the form of taxation? These programs and strategies will help you fund long-term care and provide many and various living and tax benefits at the same time. Thank you for taking time to visit with us during this presentation, and I encourage you to speak with one of our financial professionals and schedule a one-on-one consultation at no cost or obligation to you. Thank you.